Thank you, Andrew. Dear ladies and gentlemen, a special hello to the colleagues in the Harvard room as well. It's a pleasure for me to be here, and I'm very honored to share our views on the current situation and its impact on the global real estate market. So, I will start with a very quick look into the global economy and financial markets. I'm not an economist, and therefore I will leave that to the specialists and concentrate on the impact on the real estate market, the sectors, the regions, and our investment strategy, which I would love to share with you. I will focus on the office of tomorrow and modern logistics later on. I'm happy to discuss the strategy and the outlook. Now quickly to the economy. My colleagues, or our Credit Suisse house view, assumes a V-shaped pattern of growth in 2020 and 21. Uncertainty still might remain and stay high, however, we believe, and we see it actually in the real estate market, that the impact might be tough, but at the moment our figures are not that bad. So my PTI prediction and my investment schemes are still in plan. However, GDP activities dropped heavily in the first half of this year, and especially Southern Europe, suffered a lot. Japan and Germany less. However, equity markets have recovered from the sharp initial reaction. If you look into US equity, the indices recovered all their pandemic losses already. And then obviously we have got the support of the governments and the investment schemes and the fiscal responses seen now in the crisis. And I personally believe the governments and the central banks did quite a good job so far. Now, what does that mean for real estate? Now, unlike 2008, real estate is not the villain in the current crisis, but rather impacted by the economic shock. If we all recall, in 2008, we were creating actually some of the crisis. It's different this time. The good thing is, we believe that the risk-return profile is different. Why? We do have, and you see that on the right-hand side, a lower LTV than in 2008. And then we do have a limited supply in the pipelines. It's very tough to find good assets nowadays. Firstly, because no one wants to sell, and secondly, there's so much money in the market, the wall of money is really coming into real estate. And we actually took the opportunity to sell some of our assets here in Germany, and you can't believe the prices we got were tremendously high, much higher than expected. Nevertheless, there will be differences between the segments. So the total return will weaken for global real estate, we believe. More impact on retail, obviously, and hotels. I come to that later on. All in all, we believe commercial real estate is going to stay very strong. And there will be value entry opportunities like 2008, when some of us entered after the crisis. I believe personally it's a good time for people to enter in the market if you look into certain opportunities, even though, as I mentioned before, prices may stay high. Now, if you look into the segments, we all know that hotels and retail are more affected than office and logistics. So In the beginning of the crisis, I personally believe that office is not going to be affected so heavily. Now, looking into the publicly mentioned opinions, especially of CFOs, of larger tenants and corporates, I personally have to revise a bit my view. I believe there's going to be an impact, and especially line managers are now happy to have people in the home office, and there will be more flexibility and there will be a certain impact, more than I originally expected, I have to admit. But first of all, coming to the hotel business. We just sold a portfolio of a number of leisure hotels in Switzerland, and maybe we shouldn't have done that, because right now you see especially the leisure hotels in continental Europe, where you can reach the destination by car, you see that the occupancy rate is quite high. I mean, the Swiss stay in Switzerland, the Europeans stay in Europe, and especially the leisure hotels are not doing that badly. On the other hand, I have to say, we do have an office in Zurich, which normally was occupied 80% by aircraft staff and employees from the Zurich airport, and that is suffering, obviously. We took the opportunities to do a lot of refurbishment in the hotel business, but even there, the supply to do the refurbishment is tough and challenging nowadays. So hotels are under pressure. Nevertheless, I believe, especially in Europe, there are opportunities, and I think we have to re-look into leisure hotels. The focus in the last years was mainly on business and city hotels. I think there is a new view to be taken. Retail already suffered prior to COVID-19 pandemic, and we already actually did sell a lot of larger malls and shopping centers here in Leverkusen, in Nuremberg, like 5 years ago. But last week we signed a contract to buy a new center in Melbourne, Australia. We believe the pricing was so attractive. It's on Collins Street, so the main street in Melbourne. It's very exciting to look into that. So we believe there might be opportunities to look into retail, but very cautiously and really case by case. Office, I already mentioned. I think there is a bigger impact, and we have to concentrate on the office of tomorrow, and I will dig further into it later on. We believe co-working is going to suffer still a lot, and rental growth projections might revised downwards. The big winner at the moment is logistics, positively affected, and we see the trend to continue. Not so much in the US, but in Europe. Having said that, it's already priced in a lot, and we in the middle of bidding for some of the assets in Germany, the Netherlands, Poland, and it's very tough markets to acquire such a logistic asset at a decent price. But coming back to Andrew, we actually secured west of London in Bracknell, the former Hewlett-Packard headquarters, and teared it down together with Heinz, develop a last mile logistics center. So we build, and I think that's a big opportunity as well. If you construct, if you've got the capacity to develop, that helps a lot as well. Looking quickly into the markets, we believe that the US real estate market is going to suffer more, and talking to my colleagues in New York, hardly any of them had been in Manhattan lately. They all stay in Connecticut, they stay in New Jersey, and they don't plan to come back to the office not before next year. So taking the rules with regards to elevators, and there is going to be a larger impact than I personally expected before. And you mentioned that, Andrew, with London it's similar. So I think, and what we did and do, part of our team is in Raleigh in the US. So in the beginning, people didn't want to move from Manhattan down to Raleigh, But now, having the circumstances, they're pretty happy there. There's a good schooling system, they have more liberty than in Manhattan, they haven't got the commuting anymore, so there are places which are gonna win. And last year we acquired the Facebook Tower in Austin, Texas, and these places, second-tier cities I would call them, but very good cities with young, lot of good professionals, are, to what we believe, some of the winner of this crisis. I do not believe that suburban office is really the big winner, but it's too complicated. So we still believe in good places, but there are more cities who might attract, in Europe as well as in the US or Asia people. So I mentioned here Boston, Seattle, and Washington DC as well, who are going to be less affected than Miami or New York City. With regards to Europe, as I mentioned earlier, it's more Southern Europe that is affected right now, and Germany, France, and the Netherlands still doing quite good, especially with regards to logistics. I think the first one that's going to come out of the crisis is going to be the APEC area, Asia and Australia. So Australia is heavily affected right now. Nevertheless, I mentioned the acquisition in Melbourne. We do a development in Brisbane. We believe it will likely to outperform soon. We don't really invest in Hong Kong or mainland China. It always had been too opportunistic for us. We are core investors. We are sometimes do some development, some value add, but rather in mature markets, especially in Asia, where we see Japan and South Korea as a very stable market and less affected. Nevertheless, I have to admit, in the early crisis, we have withdrawn from one opportunity in Japan because we couldn't travel, we couldn't get the valuers over there, and we have to admit it is still difficult to evaluate. When we acquired the Melbourne asset, we couldn't send someone over, neither from the Singapore office. We had to depend on local support of consultants, and it's pretty tough with the regulator to get that done. So it is still a tough circumstance. Now, where do we see the post-COVID landscape? We believe it's going to provide new opportunities. First of all, there's potential for distressed opportunities. We see certain developers who are experiencing delays, as we do ourselves, because, for instance, in the southern Swiss area, we couldn't get the Italian employees who worked on the ground, the craftsmen, over to the spot, so we had certain delays, and you see obviously a certain concern with the banks. So we do believe there are opportunities on the financing side for institutional investors and for us. Second, we see, and I mentioned that earlier, price correction, especially in retail and hotels. So if you have a long investment strategy, and our investors have been with us for 80 years, you can, I think, take some of these opportunities looking in a long-term strategy. Thirdly, there are structural trends, and we have about 75 billion under asset management. So there's a big demand to work on the asset management and get some of the offices in a new shape, and I'll come to the office of tomorrow. So there has to be some actions being taken on the asset management side. Still, we are core investors, have always been core investors, and therefore we believe that is still a market we want to stay and want to remain. Quickly into the office of tomorrow, office of the future, that's very important for us. What we see is it is definitely too early to really determine potential long-term impact of the crisis. So I corrected, and I mentioned that earlier myself on that view, but we have to look what we do with all the portfolios. And all of us heard about Google not investing in Dublin, withdrawing like 2,000 people there, not hiring or not at least renting new spaces for them in Dublin. And that's an impact we hear from other larger tenants as well, that they for the moment stay away and defer decisions. We all experienced working from home. It worked to a certain extent, so I think that's gonna still remain, especially as the line managers now, other than 10 years ago, expect that as one of the working surroundings for the employees. And occupiers will drive the change by demanding attributes in offices. Safety is very important, more important, distance is important, and we always have been a strong believer in ESG, and I do see that coming back now with the initiative on the European level, but with most of us seeing the ESG impact on real estate. So we do need efficient and larger floor plates. We have more to deliver to the employees. It's not the former equivalent, like 1 person per 8 square meters. We need a different approach now, and we saw that especially with the tech companies like Google, Facebook, Amazon, you name them, and like banks like us, we really have to deliver good working places for our employees. And it has to be better quality design, it has to have greater amenities. You want to have gyms, you want to have the cellar for cycles, and need more attraction for the employees. We just acquired, during the crisis in London, a multi-use opportunity which we're going to develop, and there we really want to implement more office spaces with larger meeting rooms. And if you look on the next slide, the comments of Goldman, Google and Facebook are all alike. They want to stick to their offices. They say they need the people around the table. They encounter the best ideas in the offices, and they have still real estate office ambitions, all of them. But the demand is going to change, so that is challenging for landlords like us. So it has an impact on the architecture of a building, technology, sustainability. So connectivity is going to be very important, and we have to really rethink what we can offer to these tenants. Quickly into modern logistic warehouses. So we see, as most of our competitors, a different approach in the logistic markets and the light industry. America suffers a bit more. In Europe, it's pretty good, still very stable. That is because of the increase of online, as Andrew mentioned, shopping. It is with regards to automatization and robotics. So there's a lot of things to happen that's going to have an impact. We're going to have additional regional demand in real estate. We're going to see emphasis on highly specialized modern buildings, and some of the older buildings going to be either replaced by modern style building. The risk for an investor obviously is you have a single tenant who has special demand, and the larger tenants can really dictate certain points to you, which is not the most comfortable position for an investor. And what you really see there is that already the price is really gonna through the roof, and you have to be very careful not to pay too much for a place where next door similar asset could be built easily, where the tenant can move easily. So it's not like a multi-let inner CBD office building. So we have to be aware of that and should be very careful taking that into account. Nevertheless, at the moment it's very attractive, and if you've got a long-term lease, that's what investors really ask us for. And we got an IPO for our Swiss Logistic Fund, and it was tremendous. It was enormously high requested, and the pricing then was 45% above what we expected it to be. So the existing investor in that fund didn't want it to sell. The indices had to go into the fund, so the price was very high. So there is a large demand, likewise in residential, but in logistics among the investor community. Quickly, and then I'll come to my end. We see value opportunities in the core market. We really like the liquid markets. We're going to stay there globally. A big focus on Asia. We are a bit reserved right now with regards to the US and Europe. It's continental Europe and the UK, so it means mainly Northern Europe and the UK, which still stays in our focus. My last slide. It's a slide I love and I've been using for a while. It shows that the cap rates really came down on the left-hand side, but more importantly for us, in these low interest rates surrounding, that the spread and the risk premium of prime office versus a 10-year government bond yield is still so high globally and especially in Europe that I believe we, obviously carefully investing, can be really looking forward into a very exciting and interesting real estate future. Thank you very much.
Thank you, Christoph. I have a question for you before I go to the audience. You mentioned you didn't think, when you were talking about the office market, you didn't think suburban offices may be quite your thing. And I wondered if you could elaborate on that slightly, because I have seen in London and elsewhere in the UK an increase in interest for business park type properties in Bracknell, not far from where I live. And I wondered if that is just something peculiar to the London area, which is so dependent on very antiquated and crowded public transport, or whether that's something which you may have seen elsewhere in the world.
In general, it was the first assumption that we would use more suburban offices. In fact, the thing is, look, we have an office in New Jersey, and my colleagues say, well, it's only a quarter from my home, and I go there, but still he doesn't meet people there. So he rather stays in his home, where he has a beautiful office, all equipped with all the stuff he needs. Because why do you want to go to the office? You want to go there to meet, to negotiate, to discuss with the colleagues, to have a due diligence, to have partners there, and they don't go to these suburban offices. So that's one point. Secondly, it's very tough to develop that business. I mean, it's regulatory-wise, and in a residential area, to develop a new office park, it's not that easy, and that hadn't been on focus in the last year. So to develop that, it takes time. So it might that some of the existing parks might profit a while or a bit, but I think the attraction is not that sustainable. It might be that the market is correcting again. It's not that there is something like in Austin, or where you have a huge university community, a lot of tenants, like a space where it's not just the suburban community. So you might be right, but our impression is it's from a development view very difficult to explore there, and that it's rather tiny. It's not really good investment, at least for us with institutional investors. It's too special. It's not often a very local market, difficult to invest. So we really love the liquid market and believe that's still the place to be.
Switch it on, thank you very much. Are there any questions from the audience? If so, raise your hand. No one has a question. A question here. We'll get a microphone to you. If you could introduce yourself for the benefit of us and those not in the room.
My name is Marcus Michel. I'm a partner at Contagi. I've got a question for you because on the topic of hotels, you were just only negative on hotels, as far as I understood, on the perspective of hotels. How about transformation of hotels in boarding houses, in flats, and that's a great investment deal right now, I think, in the market.
Thank you. I was not negative. Just what we see, the current impact on business or city hotels is high. So the occupancy rate is about 20%, at least in our portfolio. So the actual business is suffering. I mentioned the leisure hotels. I'm pretty positive, and I think I stated that I was pretty positive on the European leisure hotels, like buying in Sylt or buying in Switzerland or certain leisure environments. It's pretty positive. Now, looking into the opportunities with hotel, I think yes, you can definitely rebrand them, can use them as like micro apartments and so on. I still believe in the concept of a hotel, and it's gonna come back, but it takes time, and it might be an opportunity to enter that market. Only we are core and core plus investors, so it's rather for the opportunistic players to do so. So I'm not at all negative. I think when I mentioned there might be opportunities coming out of this crisis, it's definitely in the hotel market, and there some of the opcos might suffer a lot, so that might be even accelerate the opportunity to have good opportunity there. And I see a number in our private banking arm, a lot of families, especially in the UK, by the way, who really look into that hotel market. And maybe it depends a bit how expensive it is to reallocate these assets in the market. No, but I'm not negative at all. It's just a different play. Sure. Mm-hmm.
Thank you. Does anyone else have a question? Anyone? I can't see any hands. Okay, well, we now have a panel discussion which is going to be led by Charles Kingston. So if I can ask Charles and the other panellists to come up and take your places. Thank you again, Christoph, who is taking part in this next panel discussion as well.
Great.
Okay.
Yes, I think we all have to turn on our microphones. Have we done that? Good morning, everybody, both to those in the room here and to those outside, and I think others who are tuning in live as we speak. I'd just like to say thank you very much indeed, first of all, to Christoph Schumacher for setting what I think is a very good tone for the various asset classes which we'll be looking at, and in particular for bringing a global view to this, because I think we'll be talking today quite a lot about Germany and about Europe, but it's also nice to know that some of these trends are being viewed in a differentiated way across the world, and to see the view of Credit Suisse, for example, who is buying in both the United States and in Asia Pacific is also helps to put our things in perspective. Also, my sincere thanks to the Frankfurt School for staging this event, also to Targa Communications, and between Targa Communications and the Frankfurt School there have been a number of very successful events like this, enabling us to look at various aspects of the German and the European real estate business. Briefly, a quick word to myself. My name is Charles Kingston. I'm the publisher and editor-in-chief of REFIRE, Real Estate Finance Intelligence Report Europe. We publish in English language. We've been doing this for the last 15 years, and our main focus is the German real estate market. So we have a lot of readers and subscribers to our publication around the world. We're very focused on what's going on in Germany, and our job is to interpret and report on this market. Specifically, we don't hold offices in Italy or France. It's Germany that is our main core market, and we've been doing that for several years. I'd like to now introduce our panelists, some who are well known to you, I suspect. Sascha Klaus is the Chairman CEO of Berlin Hyp, one of the biggest investors, one of the biggest financiers for German real estate. Barbara Knoflach needs no introduction, I think. Today, in fact, she's sort of playing the role of Joker. She's probably more well known to you in either her earlier capacity as the head of the SEB Immobilienfonds, and later on as the global CEO for real estate for BNP Paribas. Oshri Basacci is head of capital markets at Aroundtown, another company that's well known to you all. And Dr. Christoph Schumacher needs no introduction, having just done that himself and setting the tone for this conversation. Now, our mission in this 50 minutes, whatever is allowed to us, is to answer the question, what are the most attractive markets and asset classes in terms of risk return? And before we get on to this, I'd just like to say to you, you don't have to wait till the end of this discussion to ask a question. Sometimes some of the panelists will have said something, and if you think you want to ask a question right there and then, either put up your hand and we'll get a microphone to you. Frau Dahmen will also be able to take online questions, and when she raises her red flag, I'll be there to watch and stop things till we can take a question. So please don't be afraid to ask questions as and when they come up, or if you feel you want to ask something. I think the best thing for us to do here is to look, in the limited time that we've got available, to look at a number of these asset classes in a specific order. And we'll do that in a second. But first of all, I'd like to ask the four panelists maybe to just very briefly, for 2 minutes, no longer, because I'll shut you off, just to briefly say, Andrew mentioned earlier on what keeps him awake at night. I think it sounds like the idea of his wife spending all his money might have been what particularly kept him up at night. But if we were to just look at, if I were to ask you, what is it, each of you, that occupies most of your thoughts in terms of the real estate market at the moment? Let's start with you, Oshri.
Good morning, everyone, and thank you for the introduction, Charles. Well, what keeps me awake at night is things that are not in our control. So Aroundtown is, as most of you will know, a real estate company that invests in value-add real estate opportunities, specifically in the commercial sector. And COVID-19 has imposed some external factors on us that we have to deal with on a day-to-day basis. It impacts our decision-making process and also how we deal with challenges that come from external factors. So the things that are around the corner that are not visible to us and change the landscape of investment are really what's most challenging to us. And that is specifically for the hotel sector. But we are optimistic. We are preparing ourselves for the worst, of course. But so far we've already noticed an improvement in all of our asset classes. And I do believe that we are on the right path again to cross this pandemic and also end up even stronger afterwards.
Thank you very much. Barbara, I'll come to you. Now, as I said, you are in a way our joker today because you're bringing all this experience to the marketplace, but you're in fact here in your capacity as a co-founder of your own new startup. Perhaps tell us a little bit about that and also tell us what, if anything, keeps you awake at night?
Well, I think I'm the lucky one who's sleeping well today. So, as you might know, I decided to take a gap year, and that's really something I can recommend to everyone. But of course, that brings back a lot of creativity, yeah. And I was thinking, when I was looking here at the situation, at this special pandemic situation, I was so grateful, yeah, and really lucky about the timing of my gap year. That was my first impulse. And out of that, I was thinking, oh shit, that's a lot of change for an industry who knows that the change is ahead, but usually tends to be a little bit reluctant to be on the forefront of change. So therefore, my thought was, what could help to ease that situation? And I think, like Christoph laid it out, and you mentioned it already also, there are so many challenges in the core business of the industry that I thought, okay, what can I contribute in order to ease the situation by bringing in my know-how, but not doing the same as I did before. And that's how you end up with an idea as a startup. And then it was, again, just a lucky coincidence that my two co-founders had enough experience in that arena, because I'm not really a startup experienced person, yeah? So I'm more now the industry in that. And so we decided, okay, what is a real pain point and gives room for other solutions and energy to spend on the real important issues. And we thought one of the issues is that we have no documented, solid, digital transaction process. Yeah, so it's too much emails and too much Excel sheets, too much problems involved. And that's a routine which is not necessary. Yeah? This is just, it's a routine process. So why the hell do we have so much trouble still with that? So the blunt idea is to develop a seamless working process, a workflow around the transaction process. From the deal sourcing, through the whole process of due diligence, all the internal approvals, the allocation to the different funds, including risk management and compliance, all the way to the handover of asset management.
And this across all asset categories?
No documentation.
Across all asset categories?
Yes, of course, across all sectors, across all real assets. So we start, of course, in real estate with real deals, but you could apply the same principle to all real assets, basically. So that's where I'm spending my thoughts today, and I can really tell you it's exciting and it's new, and I hope that at the end it will help the industry to focus on the real important things rather than processes.
Very good. Sascha Klaas, does the head of a major German real estate financing organization have any trouble sleeping at night?
I sleep already much better than in March. The reason is, yes, the majority of our portfolio is in Germany, 75%, the rest is in France, Benelux, they are mostly Netherlands and Poland. Germany, as you know, is right now the strongest real estate market, so you sleep already better if you have 3/4 of your portfolio there. Then in addition, we don't have a lot of hotel exposure, and if we have it in large portfolio transactions, which are pretty much diversified in asset classes, and also in the retail segment. Broadly, we chose the right assets. So, you know, I remember I've somebody of my of my team also here in the room. He maybe remembers that one day I asked, "Do we finance almost every supermarket in Germany?" Well, now in the meantime, I'm pretty glad that we have a lot of grocery markets in our portfolio. So from that side, I sleep pretty well. I'm also very glad that we didn't get completely nervous. Because, like you said, Christoph, it's a health crisis which triggered an economy crisis, and it's not an asset class crisis as we have seen in 2000, 2007, 2008. So I think the markets are much calmer, and we are entering a phase of deeper discussions like today. You know, how will the office market really look like? That's maybe a question where I'm thinking a bit more, because I think hotel and retail, we pretty much know what's happening. Office market, I don't believe, you know, it will be as drastic as some people say, you know, minus 30%. We are people who like to work with each other, we like to socialize, and there is an important point of view which is mentioned only in a few articles, is we need to train people. How do you train people if we are all at home? I mean, I know some real estate companies who have waived a complete year of traineeship. They said, well, we're not in the office, we're not going to hire people for training. So that's a topic, and we can talk a bit more later about office spaces. That's what I'm thinking about more, because it's a very, very large market.
Yeah, and I think that's one of the reasons why when we look at these asset classes, we'll go through them, but we'll finish up with office, because my own view, and I think probably shared by the panelists, is that the question mark hanging over office is the most speculative. It's the one where there's most room for speculation as to what we're likely, to what extent the office life is going to change, and to what extent the demand for offices. Christoph, from Credit Suisse's point of view, you also look like a relaxed man, and in fact in your notes you suggested that a V-shaped recovery is on the cards. Would you quantify that? Would you temper that somewhat?
Well, that was the view of my economist in the bank, and the general view. With regards to real estate, if you ask me if I've got certain concerns, it's really, as Sasha mentioned, the office market, because having like such a big portfolio, and it's easy to say we develop the office of tomorrow and the office of the future, but it comes with a lot of capex and costs, and it's not that easy. And so I think that's gonna accelerate in the near future, where larger core investors and fund managers need to look into it. I mean, Aroundtown does a lot of hotel, retail. That's a different play, but that's opportunistic. Core players often in the office market have to face that. So I do believe that if you look, our figures, like the bank had the best half year ever. So, which is very, I don't know, I think it's for me, not being a banker, it's very exciting. However, with regards to real estate, I think we have to look into the portfolio. So a lot of asset management again.
Great. At this point, I'd also just like to point out that, but as Andrew said, that we will be talking about COVID today. I don't know if we'll be specifically talking about COVID, but it is true that this has changed things, but I think it's also important to remember at this point that as we came from 2019 into 2020, it's not as if we were all charging along blindly, assuming that everything was going to go. There were storm clouds already gathering at the turn of the year, and there was an expectation that things couldn't quite go on. Although with interest rates being as low as they are, it's hard to see what external force, what exogenous element would come into play to change things. And then a couple of months later we found out. But it is important to remember that there were already downturns in a number of these market segments as we came into 2020. Christoph, you talked about, and let's briefly look at the hotel sector. I know we've touched on some aspects of it, but as a core investor, you obviously have to take a different view. Oisin, Aroundtown, you have quite a number of investments in hotels, and you can take an opportunistic view. You can pivot and move in different directions. Let's have a brief look at the category of hotels before we move on to the next. Talk to us a little bit about your approach to hotel investment.
We've been a hotel investor already for over 10 years, basically. We've owned hotels already during the global financial crisis. We don't operate these hotels ourselves. Our business model is based on external operators having in place who manage our hotels. And we also are not exposed to their performance because we decided on getting fixed revenues from these operators. So somehow it stabilizes. But of course, you know, if every tenant in Germany gets the permission to defer the rent for entire quarter, then clearly even the most financially strong operators will decide to defer the rental payment. So of course it's a challenging time for us. And I think it's clear to everyone also that real estate is a very stationary asset class. And location is clearly the most fixed characteristic of it, but also the most important. However, I think what's important and what has always given Aroundtown the competitive advantage is to try to foresee what's the next trend, which asset class, which market is going to be the one with the highest potential in the future. And I think that's what we've succeeded to do over the last decade quite successfully when deciding on which market to enter next, which asset class. Diversification is one major part of our investment decision. And the hotel, as much as the office asset class, has the flexibility of conversion, which you don't get in the same quality out of retail, logistics, wholesale. So we all know that residential, which we actually haven't talked about today at all, probably because it's the most resilient asset class in the European market, especially in those markets where we operate in, namely Germany and the Netherlands.
And we do intend to talk a little bit about residential as well, because it's another important asset class.
Yeah, so there is of course always the fallback option. If you have a good location in office or hotels, that you can always also convert it into micro apartments or some other usages. So the value of hotels is not being completely vanished simply because there's now a travel ban. But I do believe the problem with the restriction on traveling and the reduced business trips that everyone is doing these days imposes a major risk on the business and conference hotels. And I think this is the type of hotel asset that will take longest to recover. But bottom line, in the mid to long term, I'm still very optimistic about hotels. We will continue this business. We have a fairly large portion of our portfolio in hotels. And even though offices is our main segment, but I do believe that once there's better medical treatment, or maybe even a solution to the vaccination issue, that traveling will kickstart again, and that also offices will experience a revival. We already see during the summer months much improvement compared to Q2 in our occupancy levels.
Sascha, Klaus, your bank finances hotels, or you did?
We did finance hotels, yeah. Mostly business hotels, not luxury hotels. Of course, banks have become a bit careful the last few months. I'm sure they will continue in general to finance hotels because I believe in a recovery in general, especially the business hotels, the 3-star hotels. At the end, and I'm completely with you, if we have a good health treatment, traveling will restart again. You know, if 5 people make a pitch via, the internet or Skype, yeah, and you are the one who travels to your client, yeah, who might have maybe the best chances. It's just natural, you know. We want to meet in person, and this is why it's going to come back. It came back after the last financial crisis. It took 3 years. It might take again 3 years for hotels to come back. Not every hotel will survive. This is clear. You know, smaller franchises might not survive. That's why might also be a good opportunity to buy into this sector. Yeah, it's opportunistic, but it's not dead. It will come back.
Barbara, you look as if you've got something to say on this.
Yeah, you know, just by listening, 2 big questions are popping up in my mind currently. One is, okay, what have been the structural problems we already have seen in the past? not only in hotels, but obviously in all the different sectors. So that's the first question I would raise and think about what would that anticipate. And then the second question for me would be, okay, what's going to happen after COVID? So what is the new world? Are there really big changes, or are we falling back in an old world? I think falling back in an old world is very unlikely because of all the structural problems and all the mind shifts we have seen already in the past is one reason. And second, COVID, in my view, have brought a few aspects back into real life, and everyone was able to feel it. One is that we are social beings, so we don't want to sit only at home. Yeah, I think everyone was experiencing that feeling. So that will bring a new connectedness. And the question is, how will that then work? And our properties are, at the end, in all the sectors, just a logical development of the way we want to be connected in the future.
And one of those ways we want to be connected is by going on vacation, which is sacred, as we all know, in Germany. And as Christoph rightly pointed out earlier on, you have to differentiate between the asset categories. There are office or business-related hotels. In fact, the one I'm staying in myself here in Frankfurt is practically throwing the rooms away. They're so cheap to get business here in Frankfurt. But on the other hand, as you mentioned, Christoph, in the holiday and the leisure market, up on Rügen and Usedom and in Bavaria, the hotels have been booked out for months. They're having a bonanza of a season. So I think it does make a difference, and I think that the question though is going to be, and Oshri, as you said, you believe in it long term, but in the short term, an awful lot of hotels must be struggling so badly that they. I talked with Premier Inns recently who are expanding in Germany, and they're saying there's no question about it that come the autumn, round about now, towards the end of the year, there's going to be a lot of interesting entry opportunities into the market because of hotels that are going bust. So the question is, how long can a lot of them hold out?
Well, I do fully agree with you that over the next few quarters, especially next year, we will see more and more financially distressed owners, more the private, smaller ones, who will be forced to sell at a significant discount. And we are preserving our capital at this point in time also to be at the right financial position to then execute on these deals. And I also agree that some hotel operators suffer at the moment significantly, but you have to take a very granular view on this. The leisure hotels, they are actually really doing well right now. One of our largest tenants is Center Parcs, for example. So they are obviously also doing better than a conference hotel that depends on large conference and gatherings or an airport hotel. So these are the ones who suffer right now a bit more. And they, of course, need to make sure that they somehow get through and cross this valley where there's so much uncertainty in the market and nobody really knows what the next few quarters will bring. So,
I think that's a very tough bet, sorry to say, because at the end you are betting that there is a vaccination available next year. Otherwise, I do believe that with all the hygienic measures and regulation we will continue to have, like you just need to have a look in this room. It looks very different than a year ago, I would say. Yeah? And the same is, of course, true for all the hotels and the offices and so on. So not specifically on hotels, but if we do not have a vaccination next year, what's then? Then I think the approach how to run a hotel needs to change. And then the next question is, if your hotel operator is not really good in adapting and in changing into this new hygienic world in which we are, then of course the landlord will also suffer. So for me the question would be, does that need a tighter way to work together between landlords and the operators as such in order to define the future? And of course, Christoph pointed it out, that's a real pain point because that's costs. That's always CapEx. And then the question is again, how do we generate the income to make that work? So I think that's the real, that's the creativity which is needed in the future in all the different, in the different classes. Because if we are lucky, we have a vaccination. But if we think about other viruses, there is no vaccination, and we still will have them. So just imagine for a few seconds what happens if we have to be in that situation for another 2 or 3 years. Yeah, masks, 1 or 2 meters distance, and so on. So what's the impact? That's my big question, honestly.
Well, we also have a question from the back here, perhaps related to that. Yes.
Is my name, JLN Frankfurt. I just have a question to the panelists, because they're not only investing in office sectors, but they're also using office spaces for their own employees. And my question would be, are they willing to occupy more or less spaces in the future?
Well, perhaps we could keep that question till we get on to offices, because I think it is more related to the office segment, and I think that's an area where there's, as I said, more speculation than almost in any other of the sectors. Let's briefly have a word. It's not particularly on the agenda to talk too much about residential, but there's no doubt about it. It is a major investment asset class. I have to say, yesterday I was listening, I tuned into the Herbstgutachten, the ZIA Herbstgutachten, which they exceptionally had after 6 months to have a look at where we are in the German real estate market. And among the speakers was Harald Simons of Empirica, a man who has been known for the last 5 years to be predicting a 30% fall in the price of residential, that everything's overvalued. And you know, I think we even commented a couple of years ago that even a stopped clock is right twice a day. You know, at some point in the future, prices are going to fall. But even he conceded yesterday in his talk that while things like internal migration within Germany into the big cities has slowed down, he's sort of withdrawing from his prediction that residential prices will at any point start to fall. The reality is that while rents are falling, and there's reasons for that, particularly in a place like Berlin, the price of real estate, of residential real estate, continues to rise. What would the panel think of what's your general view on residential, German residential as an asset class? Christoph?
Yes, Charles, we do a lot of residential in Switzerland, and we just had capital increase for 2 of our resi funds and high demand from institutional and private investors, and we build a lot. We've got 1.3 billion under construction in resi in Switzerland. I didn't mention that so much in my presentation, because outside Switzerland we hardly do any residential. Why? Because we've got a small team and we have to concentrate our capacities on the other asset classes, commercial asset classes. Having said that, in Berlin we have got 2 developments, and one is definitely having some resi in there. We're very positive. So we do tremendously well with resi in Switzerland, but I'm the wrong one to be really concentrating on the German resi market, because that's not in our main focus. So I think Sasha or all of the others could rather talk about that.
Sasha, you put your money on the line in this segment as well, so obviously you've got a strong view.
Yeah, it's a great asset class in Germany, I have to say. Very resilient. We don't have enough apartments in Germany. We say it year and year to the politics, you know, to make the circumstances easier to build housing. Now with the crisis, everybody sees now that interest rates will stay for a very, very long time very low. It's just much more affordable to buy an apartment or a house. Then also with the crisis, people are seeking for security. You had a lot of tenants who say, okay, you know what, I want to own my apartment, my house. I don't want to be dependent on somebody. Yeah. And if I lose my job, you know, I don't want to be thrown out right away out of my apartment. So a lot of security thinking has come through COVID-19. Then another effect is working from home. I think you can see who has a very tiny apartment and likes to still come into the office, and who in the staff has a house with garden, etc. It's very hard to get them back to the office. I'm joking a bit, but the seriousness behind it, that people want to have better living conditions, because they probably know they might work 2-3 days a week at home, and later in the panel we'll discuss maybe if it's more or less, but there's a need for bigger spaces. So that also creates a development in the housing industry. Where do you have the biggest value when you invest? Yeah? I think the surroundings of the big cities are becoming more and more attractive, because downtown is extremely expensive. People who want to now move into a house, they can afford more, in the outskirts. What is also becoming more and more attractive is, the big cities, the strong cities, good employers, good networks, public transportation into the big cities. That's also, I think, an interesting investment opportunity. In the less attractive regions where there's less industry, we've been talking in Germany already for a few years that prices are not really increasing, but they are not also crashing down through the crisis. There are a lot of areas in Eastern Germany who had also a negative, or not as much a positive development as the rest of Germany. Is not crushing down, but still I would focus more on strong B cities, the outskirts of the large metropolitan areas. That's gonna grow in value.
Well, I see two very clear winners out of that pandemic, and that's definitely residential in general and logistic. And both, I think, are not coming as a surprise. Logistic, I think, is very long underway with the fall of retail, or let's say the change in retail. And
we'll look at that shortly.
Yeah.
But talk about accommodation.
Yeah, residential, I think, especially in Germany, you had for so many years the situation that there was very high demand and little supply. Yeah. So in Berlin, you had a situation where there were 7 persons or 7 whatever, wanting to buy or rent an apartment on one built apartment. And in Frankfurt it was even worse, it was 10-1. So with these figures, I think it's obvious that with the health issues you were just mentioning, and the desire to be safe and healthy, the trend is very clear everywhere. And it might even have kind of an impact on offices. You mentioned the suburbs in half an hour ago. So for me the question is, in cities like Paris, for example, where people are sitting with 4 persons in 60 square meters. In London you have that very often the same. And now they have home office. That's hell. That's really hell. After 2 months, you're getting crazy. And that's precisely what's happening in Paris currently. I think that's one factor why the infection is going up. So they need either to go back to offices, or they need expansion space to have a home office somewhere outside of your own apartment.
Well, let's look at that. If you mentioned safety as being an important aspect of this. What is safe about the current German residential market? In other words, home ownership has hardly risen in the last number of years, despite all sorts of threats about Altersarmut and old age poverty and the inability of people to buy their own 4 walls. This isn't really happening. So when you talk about safety, what is the safety of having your rent rising by 5 or 10% every year in the absence of Mietendeckel or Mietpreisbremsen?
Well, that's precisely the argument, and I think Sasha mentioned it already, why prices will not go down. They will even, I do believe that in Resi you will see even price increases, because people want to have more ownership. And you know that the low ownership quota in Germany is an heritage of the political landscape. So therefore I do believe that we will see a rise in ownership in Germany over the next decade.
One thing we're definitely already seeing is in cities like Berlin, for example, where they've introduced the Mietendeckel and the Mietpreisbremse and enforced very strongly that the inevitable consequence of all of this is that Mietwohnungen get removed from the marketplace. So there are in fact less Mietwohnungen, and this inevitably pushes the price of existing properties up. It's a no-brainer, isn't it?
This is why it's stupid. This is, everybody in the real estate says the Mietendeckel in Berlin is stupid. It's not social. It's anti-social. And I hope, you know, like everybody probably in this room, that the Bundesverfassungsgericht, you know, is gonna abolish it. Full stop.
I think it's the expression of the helplessness of politicians, honestly. I'm sorry to say, and no offense, so please. But if there is no room to maneuver, to ease a situation, they have to do something. And usually but that's not only for politicians, that's everywhere, honestly. So you choose an easy path. And you see that with the Mietendeckel in Berlin, but you also see that now in Frankfurt with the discussions about, how do you call that, Viertelschutz? Yeah?
Milieuschutz.
Milieuschutz.
Milieuschutz, yeah.
Milieuschutz. It's crazy, yeah? It's really crazy. It hinders developments, and it's very often creating the opposite of what they want. But it's just the sign that we need change. And we need to find a solution together and not against each other. That's always the problem.
Well, investors are obviously taking the view. I mean, Ahti, do we have a question? Yes. Paul Mona, yes. And another question coming in from outside. Let's take those. Let's take them.
Thank you. I'm Paul Muna of Principal Real Estate in Germany. I guess, Barbara, it's not the helplessness of political decision making. I guess it's the incapacity of doing something, because nobody's asking how long does the approval process takes. Ask to increase the altitude of a property in Berlin, in Munich, or in Frankfurt. It's impossible. And there's so much room for improvement. And if we start to increase the velocity of the decision-making process, this would enhance everything in each city. So I don't know if the politicians will learn something out of this, but at the end, each person is suffering, looking for a flag.
Yeah, and if you look at the movements of the stock market, for example, even the big listed companies, you're a listed company yourself, Ashley, Vonovia, Deutsche Wohnen, they're able to sign citizens' charter agreements for 20 years in the meantime, fully confident that in 20 years' time that the demand for residential housing is still going to outweigh the supply in a city like Berlin and across Germany. And that, what does a company like yours say to that? I mean, you also have a sizable stake in Grand City Properties, which has big exposure to residential.
Yeah, we don't invest ourselves directly. We have that exposure through another company. I'm not a fan of the Mietendeckel, and I'm also very bullish in the long term on the residential in Germany. I do not put all the fault on the politicians though, because also the large real estate companies, they could have imposed some restrictions, some kind of rules to play the game themselves. At the end of the day, it just overboiled in the market and the outcry was too big. So the politicians had to take some actions. I don't think they took the right actions. I think it's actually counterproductive what they do. I agree with you, Paul, fully that it takes way too long to get building permissions. We see it no matter what asset class. There seems to be some hesitant from some hesitations from the authorities to actually accelerate the building process. It's a problem that we see all over Germany. Berlin, of course, much more. They have even forbidden a few years ago to convert multifamily homes in some parts of Berlin into condominiums, which again doesn't help to actually buy your own condominium. And Germany itself, I think it was mentioned before, it has this political culture or history why we have such low home ownership. At the end of the day, Berlin was never a rich city. And if I rent an apartment and lose my job or can't afford the rent, I will get some support from the government to live somewhere. But if I own an apartment and I can't pay my loan repayments anymore, the apartment will be taken away from me. So it's not favorable or business friendly from that perspective. And I do believe that we are in need of a significant change. However, it should not look the way the politicians are trying to implement it right now.
All of that is clearly pointing to a champion within the winners, and that's affordable housing.
Affordable housing. We'll note that. We have a couple of questions.
Yes.
Madame.
Yes, we have a question to Christoph and Oshri from Lieber Vincent. Since interest rates remain low, what will real estate yields do? What is the asset class to focus on?
Thank you. So
Again, may I ask, did we keep that question to the end? Because we've had a look at a couple of other asset classes.
What is the asset class to focus on?
Exactly. So, let's keep that question. Susanne Klausner, a question.
During the last months, I was wondering about the combination of home office and the high demand in the top 6 cities. So isn't that a big chance for the B and C cities and cities in the nearest surrounding with a good infrastructure to benefit from the actual situation?
In terms of establishing centres, office centres, or in terms of places to live, or?
No, we're talking about residential. So
Yeah, okay, very good, yeah.
I thought it could be interesting to live a bit more outside, having a bit more space surrounding you.
Yeah.
Especially in these pandemic times. I mean, we were all happy to have a garden, I think.
That's right. And Christoph, you mentioned that there is already perceptibly noticeable higher demand in, for example, the Speckgürtel around these towns. So that, for example, although we don't have anywhere near the same problems of commuting into big cities in Germany than they do in, say, Paris or in London in particular, there's been a noticeable rise in residential pricing outside of the big cities, or within reachable, commutable distance to the cities. Isn't that right?
To a certain extent, it's definitely right, and you see that. Having said that, we still see the higher increase in the top locations. So it's still the apartments in the favorite, like 6 top cities in Germany. In the markets we are active, we see obviously where the infrastructure is good, like in Paris, where you've got the Bigger Paris initiative, where you've got good infrastructure, people commute and love to commute and move more outside, but you have to find the right spot. So there is more volatility in these second-tier markets still. It depends on certain preferences of people to live, and so yes, definitely there's a high increase in B and C cities. Nevertheless, the more stable ones are still the big main, as we call them, liquid markets.
Yeah, and I think that this is where the area of residential overlaps a little bit with the whole question of the future of office space. I can see that here in Frankfurt there are still giant office buildings going up, so there's obviously project developers taking a very opportunistic or very, very optimistic view of the likelihood of higher demand for office space in the coming years. I think, given our time limitations, there are other asset categories which, like retail, for example, or logistics, which we could look into, but I think they've been covered in other areas in greater depth. And given our time limitations, I think we should get on to the question of that which is probably troubling most people, like what is the future of offices, and where offices and residential overlap is going to be probably the speculative question of the next 3 or 4 years. Barbara, will there be demand for more or less office space in your view, or will it just change?
That's like a crystal ball question, Charles. Yeah. So let me try to answer it slightly differently. I truly believe that there will be need for office space in the future. So that's clear. I think we are social beings. We cannot create company cultures without offices. We need meeting places, and I doubt that we will have all of that in the future in the big halls of hotels. So I just doubt that. So it's my personal view. Do we have more or less? That's a very tricky question. That's again, I would say in the short term, a bet on a vaccination. Yeah, because if there is a vaccination, I think that the need, just the pure need, will press everyone to fall back in old habits. Yeah, yeah. I think the budget session of this year will prove that in a bit. So then I think the trend will be short-term less office space, because everyone will make use out of the cost-cutting efforts, and it's easy if you have an expiring lease, you just walk out of the door and increase your home office quota. On the medium term, or maybe let's start with the other scenario, no vaccination, still hygienic measures. Then I think people will start to think about, okay, first of all, everyone knows that currently in the high-rise office buildings you have only at the max 40% of your staff, due to elevator rules or due to the 1 or 2 meter distance rules whatsoever. Yeah. And with 40% of the people you had in the building before, of course, in the medium term, it is likely that you would need more space if you would like to come back to a normal home office quota of maybe 70–80%. Yeah, because home office is also here to stay. Yeah, and there's, for me, the question: where is the break-even of those two equations? Yeah, and that will, at the end, decide over the next, I would say, 2 years, 3 years, about more or less office space. But one other thing is for me crystal clear. We will need more quality. That's the health and the safety aspect. So the problem is obvious with the elevators in the high-rise buildings. The air conditioning will be a big issue. The cleaning of the buildings, disinfection, etc. So health and safety is high, and that is a good thing, because finally we are at a level where the nice term ESG, environmental social governance, is not only the E, because in the past we were focusing more or less on the E, on the environmental issues. Now I think in the next 3 to 5 years we will have the S in the focus as well.
Sasha, you're not only a financier, but you're also a project developer, in the sense that you're developing your own new building as a headquarters up in Berlin, which is exactly, in fact, as a financier, you've made sustainability part of your decision-making criteria for investing in offices. Tell us a little bit about your own project.
Yeah, it's true. We are building a new headquarter building in Berlin. We have right now 2 buildings. One we will tear down and then bring all the staff into one building. Maybe it's the perfect timing now with COVID-19 to enter into the planning phase, how the layout will look like, and certainly we'll make adjustments now, about what we were thinking a few months ago. I'm with you that we will have different layouts in the future in general. Also in my bank, we'll be thinking about having more spaces where you have a bit more distances, spaces where you don't have these open floor plans like they're typical in huge buildings, but you have quiet zones, probably more conference rooms, also smaller ones, because now we have a lot in our staff, and I'm sure you experience it also in your companies. The staff says, I can work more quietly at home. I don't want to come back into the office. And as an employer, we'll have to find solutions to make it attractive for them to come back. Because I don't believe that we will have long-term a very, very high degree of working from home. Because the culture will suffer of a company. And I always say also in my firm, culture eats strategy for breakfast. If you lose your culture, it deteriorates. That's the biggest impact. And this is why, as employer, we will have to bring people back into the firm. But it will be a new balance, you know. Before the pandemic outbreak, if I would have asked my staff, let's have a desk ratio below 100%, they would have said, you're completely crazy, no way. The Workers' Council would have called me right away. Now, if I say to the Workers' Council, well, you know, let's say 80-70% desk ratio, nodding, no problem. That's the shift we have now. Yeah, this will stay. That we have now in industries, especially in the service industry, a desk ratio potentially below 100%. Then you have to also differentiate, I think, between smaller companies and big companies. The big question mark we have all on our face right now is because we don't know exactly what the really big companies, the big employers, will do. Right now, all the CFOs are talking about, and I know it because I'm not only the CEO, but also the CFO of our bank, you just have the dollar signs in front of your eyes and say, okay, I can cut costs. Yeah. Also, with our new building project, we said, let's build the maximum in volume. We can do it in that space, and then let I don't know, maybe a third to somebody else. So all the CFOs come now and say, well, great, I can cut costs. Yeah. But at the end, I'm not sure if the CFOs in the long run determine the office strategy. Yeah? And we also in our bank observe that the branches, basically the smaller offices, the microcosmos, like a family, they are much more back into the office than in the headquarter. And you know, I spoke to some other colleagues also in the US, and they confirmed also to me that the smaller companies are to a much higher degree back into their buildings, and the big ones, the big banks, etc. in Manhattan, they're waiting. They're waiting, you know, the path of vaccination.
They're certainly struggling. And JP Morgan said yesterday or earlier on this week, they said, that's it, we want you all back into your office. But again, it is a differentiated market. As Andrew said, in London, they can hardly get people to come back to work, and the whole ecosystem surrounding this, the pret-a-mangers and all the hairdressers and the clothes cleaning operations, they're all going to the ground because of this. Barbara, before you come in, I'd just like to say, Oshri, you've got 40% of your investment, your company's investment in offices. It's a very clear statement from Sasha Klaus that it's not just a question of whether office as an asset class is going to be the favoured class, but the question is now, what kind of office? And there's going to be a huge differentiation, obviously, between offices which meet the specs, that also enable people to come back to work and bring them back into the office in the so-called war of talent. These have to be very special kind of offices for people at this stage to turn their backs on home office and say, we desperately want to come back into work. What do you say?
Well, we even have 50% of our portfolio in offices invested. And I do believe as long as this is a decision by choice, not government regulated imposed decision, how many people have to work from home, how many can stay in the office. It will be, as you said, a decision driven by cost savings, and the employers eventually will choose, depending on their needs and their situation, how much they would like to save in terms of number of desks. What I can see is that, again, here we need to differentiate again. Cities that in European or international context are more expensive, such as Paris or London, where the commuting time is much longer than the average in Germany, and also the cost per desk is much higher, they have a higher incentive to send people home working from there. And people also, you know, they probably gain more quality of life by not spending 3-4 hours a day commuting back and forth. On the other hand, I do believe, or I'm convinced that productivity will suffer significantly if a large portion of the workforce will start working from home. We spoke about the DNA of a company, we spoke about onboarding new employees, work-life balance, exchange of ideas, innovations, the perks that employees get in office. We have a gym. These also make employers attractive. So I don't believe in a long-term work from home situation, simply because we are social people. And there's also enough arguments why employers need more space. I have experienced over the last 6 months that hardly any of our office tenants whose contract expired actually left the place. They stay put because they simply didn't know what's coming around the corner. They don't know whether to increase or decrease the space, so they simply extend it where they are. And I think that is a clear sign of uncertainty, and people are still struggling with taking a long-term decision here. And in our own office, people came back to work sooner than they actually were expected to be, simply because they felt that working from the office is more suitable for them. Not everyone has a garden and 2 spare offices at home to work in peace and efficiently.
Christoph.
Yeah, just to add and to answer Achille's question about that, I totally agree with all of you. The only point is we do have, for instance, one office where we have got 6,000 people working there in like really open space, and that is difficult, and that's going to change. But it's not in my responsibility. I've got a colleague who's responsible for the corporate real estate, and as Oshri said, it's too early, actually, and you said it's a bit too early they haven't come to a decision yet, but there are going to be certain impacts. I totally agree, we are social people, we want to go back to the office, and I love it in the office too, to be honest.
I think that it's also an issue of that most of the tenants in the buildings do need to find a new business model in a way like a digital enterprise management, because all of them are now faced with the home office phenomenon, but they have no tools. You see the boom in the IT because everyone needs support here. And a year ago, most of the staff didn't even have a notebook to work from home. So that reflects the workflows and the processes, the operating models of the tenants. And as long as the new operating model in a hybrid world, because the hybrid world will stay, I think that's really clear. So before that is not settled in a good way, it's always a bit tricky to predict office space needs.
As you can see, ladies and gentlemen, we're only touching on the surface of what would be a long debate. And I've no doubt this will be thrashed out again in various sessions in the course of today's programme. I'd like to just finish up by coming back to Fadam. That question from Lebo Vincent sent in, maybe we could just wrap up the session by putting it to the panelists. What was the question? What do the panelists feel, in a brief sentence, is likely to provide the best risk-yield relation over the next couple of years? In a short sentence each, please. I know it doesn't do justice to the depth of argument which we would have to have, but go ahead. Oshri.
Yeah, I think the question from Lebo was which asset class is most attractive in light of falling interest rates, or interest rates remaining low, if I correctly remember. Well, yeah, you have to look at different markets, different asset classes. The residential exposure that we have grew over the last 1-2 years, specifically in London, because Brexit actually brought some opportunities to the surface that you couldn't find in Germany. Before that, it was some C and B cities in Germany that gave you the highest yield. So there is clearly a shift depending on the demand and the pricing level. We all know that prices are not regulated in Germany. So here, I think the gap between rents and prices can increase further, and that will be irrelevant in the short term of the interest rates.
Barbara.
If you want to swim with the swarm, then logistics and residential, that's obvious. If you really want to make money, real money, then I would go into the most distressed ones, which is hotel and retail, obviously.
Sasha?
I think you can make in every asset class money. You know, risk return is always a question of your business model. You can be safe with residential in Germany, logistics, everybody's going in, but the yields, you know, this will be difficult. Everybody's, you know, it's like a swarm. And office, it's choosing the right buildings, the right locations, the right tenant mix, layout, flexibility. Then you will also be on the safe side. And what's really interesting, I think, is senior living houses. Don't forget, we're all getting older. And maybe also living as a specific asset class, not just the apartment, but all the servicing around. Think about the next generation, our kids, how they live. Yeah, they say, okay, give me an apartment. I don't care how much it's per square meter. I pay 800 euros because I have fast internet. You give me all the services. I don't have to bother about it. This is a model also, I think, which will become more attractive in the future, and some asset managers are already focusing on it.
Barbara, last word.
One thing in my own issue, I found it precisely on that topic. Last year already, a charity company for an art project. It's called Tiny Bee, and it will be an exhibition here in Frankfurt next year with livable, habitable sculptures, yeah, so you can live in them. But the main issue is, the reason why I found it is because of precisely that questions. What are the new ways of living? And we wanted to discuss that in a space where there are no killer arguments.
Good. Christoph?
We're going to stick to our strategy, which we have been close to for the last 80 years. It's really the liquid market, but I take Sasha's point very seriously. A generation, how generations and all the generations gonna live, that's gonna be very exciting to look into it. But we are diversified. We might do more retail again, which we have sold 5 years ago.
So the message I'm taking from all of this then is that although COVID may be an issue, the main determinant for your general optimism is in fact the low interest rate environment, which is likely to continue for the next number of years, and with the amount of pressure from investors to invest, nobody's going to be disappearing out of the real estate market anytime soon. Is that more or less what you would all agree to? Very good. Very good. Our time has run out, ladies and gentlemen. We've covered a number of subjects here, some of them only superficially, but I think there'll be an opportunity in the course of the rest of the day to go into some of these in more depth. It's been a very stimulating discussion. Thank you all very much indeed, and I look forward to the rest of the day. Thank you all very much.